Concept number 19, credit derivatives. Credit derivatives are some derivative instruments which are very much like insurance contracts. Okay, so there are various kinds of credit derivatives like CDS, credit spread option, total return swap, etc. So let us take up each of them individually. First one is concept number 20, total return swap. As the name suggests, in this case, the a bond holder, he is skeptical that the bond can default anytime, may default in the future. So he will enter into a contract with the seller that whatever is received on this bond, I'll transfer it to you, be it interest payment or principal installments or benefits of the change in market value, then all these will be transferred to you. In return, you pay me a fixed or a floating interest rate, that is a fixed percentage. So this way the bond holder has transferred the risk on this bond to the seller. So effectively the bond holder has insured his risk. So this is total return swap. Then concept number 21, credit spread option. What is spread? Spread is the difference between bonds yield and benchmark yield. That means the return on the bond minus the benchmark yield. You can consider this benchmark yield as the return on a comparable bond. So the bondholder is concerned that the credit quality of this bond might fall in the future. As a result, the return on this bond can fall. When the return or the yield on this bond will reduce, as a result, the gap between the two, the difference will increase. So the arrangement is done in such a way that if the yield spread increases, then the bondholder will collect a payoff on this option. So effectively what he has done, he has insured his risk of the bond defaulting in the future. In order to avoid confusion in exam, always try to derive the meaning of the instrument from the name itself. Okay, so in this case, you should be able to understand what this spread option is all about. Okay, so the name should give you the clear picture about what this instrument is. Concept number 22, credit linked note. In this case, you are a bond holder and you are receiving payments on a bond. Yes. So on the basis of the payments that you receive on this bond, you issue one security of your own, that is called CLN. So this has been issued by you to the seller. And the payments on this note, this security is linked to the payments on this bond. That means till the time you are receiving the payments on this bond, the installments on this note will also be serviced regularly. However, if there is a default on this bond, then the payments on this note will also be affected. Okay, so ultimately you have passed on the risk of this bond to the seller. This is credit linked note. Concept number 23, credit default swap or CDS. This is exactly like an insurance. Like as in insurance, we pay insurance premium. In this case, the buyer pays CDS fee or what is also called CDS spread. And against this, the seller gives a promise to cover the risk. Okay, so in case there is a default an event like bankruptcy or installment default, etc., in that case the seller will make the losses good for the buyer. Concept number 24, asset-backed securities. We have a detailed reading on this in fixed income. So we are going to read this in detail there. For now, just broadly understand that asset-backed securities are a pool of investments where you have a lot of debt securities, then all these are pooled together, and then on the basis of this pool, new securities are issued, and the payment on these securities are dependent upon the receipts from these debt instruments. Okay, if these instruments default, then the risk of these securities will also increase. So based on risk category, there are various tranches. The investors are divided into multiple categories like tranche A, tranche B, tranche C, etc. So that is in the order of safety. Tranche A will be the safest and so on. Okay, so this is the basic phenomena, how asset-backed securities work. Anyway, we are going to read this in details in fixed income. Then concept number 25, hybrids. So these are nothing but two or more instruments combined together. For example, an option can be combined with a bond, which is called callable bond or convertible bonds. Similarly, options can be combined with swaps to create swaptions, etc. So these are some example of hybrid instruments. Concept number 26, criticism of derivatives. It is said that derivatives are a legalized form of gambling, but there is an argument that it is an effective tool for risk management. So basically, this risk is taken by those who are willing to take risk. And those who don't want to take risk, they can definitely hedge themselves against the risk using derivatives. There is limited knowledge in the market. There are many participants who participate in derivatives with little knowledge. So, for that, investor education is required, and regulatory authorities are taking steps in this regard. Then, another criticism is that derivatives are complex instruments. So, again, the answer remains the same, that investor education is required for this. Next is, derivatives are high leverage instruments. Yes, it is true. But to keep a check on that, there are margin requirements and strict regulations. And lastly, market destabilization. Yes, it is very famously quoted that derivatives are weapons of mass destruction. But the argument is that market crashes and panics have a very long history. When there were no derivatives, even in that case, markets have crashed. So, to blame derivatives only for market crashes will not be justified. Concept number 27, arbitrage. This is an opportunity to make a profit at no risk with investment of no capital. These two are important terms. There is no risk and there is no capital. So what happens in case of arbitrage? The investors try to look for price discrepancies and trade quickly to take advantage of this opportunity. However, that opportunity or that window usually remains open for a very little time, because when people locate such discrepancies, when arbitrageurs locate such mispricing, then very soon people discover that mispricing, and as a result the prices converts back to their fair value very quickly. Okay, so this improves the market efficiency and price discovery. Let's say an option should be priced at $30, but for some reason it is currently trading at $29. So as a result, there will be many arbitrageurs placing orders at this price, and as a result, the price will shoot up in a very little span of time. So basically, although arbitrageurs try to make profit out of this situation, but they are also helping the market to discover the true price of the instrument, and this improves the market efficiency. However, there are two limitations to arbitrage. The first one being illiquid markets, because in case of illiquid markets, the arbitrageurs are not able to offset their position when needed, and also high transaction cost is also a limitation to arbitrage, because these mispricing or these price gaps are very small, and these are so small that after paying for the transaction cost, this does not make sense to take such kind of trades. So these two are limitations for arbitrage. Then there is this concept of law of one price, which states that two securities or portfolios that have identical cash flows in the future, then regardless of future events, should have the same price. That means if security A and security B both are going to deliver $100 in the future, then no matter what, the price of these two should be the present value of this benefit, that is, let's say 90. If for any reason this one is trading at 89 and while A is trading at 90, in that case there is a discrepancy, and in that case arbitrage opportunity arises. Okay, so we can say that whenever law of one price does not prevail, only then arbitrage opportunity is possible. And this way we have completed reading number 45.